Hi, everyone. Welcome to today's webinar, Raising an Impact Investing Fund During COVID-19. We're really glad that you're able to join us. Just a few house rules before we start. Your mics are going to be muted for the duration of the webinar to ensure that we can maximize video and call quality. We'll leave ample time for questions and answers, so we encourage you to use the chat function to send us your questions throughout today's discussion. And finally, we encourage you to join us over video if you feel comfortable. Thank you so much. We're going to kick off today's session by turning the mic over to our moderator, Rahana Nathu, who is the founder and CEO of Spectrum Impact. Welcome, Rahana.
Thanks so much, Carmel, and welcome everybody. Thank you so much for being here. Those of you who have been with us since the beginning probably know that this is our final episode of this part of the series. And so we're so thrilled that you're here. It wouldn't have been an impact investing conversation in the time of COVID-19 without a conversation around fundraising. And so it was really important to us to bring together some folks who really have quite a track record and experience around building, launching, and raising funds for impact investing work. So I'm thrilled today to be able to pick their brains for the 45 minutes that we have and share some of the questions that you all have. We want to jump right into it. As Carmel mentioned, if you have any questions for our panelists, please feel free to message them into the chat. Time permitting, we will make sure to get to them. The ones that we don't, we'll make sure we get back to you. And we will be sending contact information for the folks here if you need to get into further touch. So the conversation is just the start. I am beyond thrilled to welcome Will, Priya, and Monique today. I'll tell you a little bit about them before we get started. Will be a familiar face to some of you who have been with us through this series. He's a senior director at Kiva Capital, which is the impact investing arm of kiva.org. And for those of you who don't know, Kiva is a global nonprofit dedicated to expanding financial access to help underserved communities thrive. We also have Priya Parrish. Priya is the managing partner of private equity at Impact Engine. Those of you who don't know Impact Engine, it's a venture capital and PE investment firm that focuses on companies that generate positive outcomes in a range of sectors, including education, healthcare, and the like. And Priya will tell us a little bit more about how that mission statement has evolved over time, which we're really looking forward to. And last but never least is Monique. Monique is the founding partner of Cake Ventures, which is a venture capital firm that invests in the changing demographics that are changing technology. And we'll be able to hear a little bit from Monique how that thesis has evolved, especially in light of what's been going on across the country over the last few months. So without further ado, I think we'll pop in. And the very first question, just to get us started this morning or afternoon, wherever it is exactly that you are, is for each of you to tell us a little bit about the fund or funds that you're raising. And if you could help us contextualize what that is based on who they serve. Either the beneficiaries or the thesis that you're exploring. That would be a great way for us to start. And Will, maybe we'll kick it off with you.
Sure. Thanks, Rahana. And thanks again for having me for a second time. I feel very privileged to be part of this 2 times this summer. I thought for a bit that you just had me on to make your other panelists look good. But a colleague looked at the bios of the other panelists and said they don't need any help looking good. So, but no, it's fantastic to be here. It's been tough not being on the conference circuit, being able to see and meet with all the fantastic people in the impact world. So these webinars have been a really kind of helpful substitute for a lot of that. I'll start a little narrow. So we were in the midst of raising and getting pretty close to closing a vehicle focused on financial inclusion for refugees around the world. When COVID-19 hit, we had to kind of stop and reevaluate everything we were doing. We were tremendously fortunate as Kiva Capital, as the investment arm of kiva.org, to have access to other types of capital. And so while we were looking to deploy investment capital, we recognized that as many microfinance banks were shut down, were not operating, they were not optimal targets for investment, but were optimal targets for other types of capital that Kiva has. Most specifically, the really risk-tolerant capital that comes to our crowdfunding site. So the decision was made to really focus on that. We did recognize, however, that closing this fund was a tremendous signal to our partners that on the other side of COVID-19, bringing these fragile communities into kind of the formal financial system is going to be as critical as ever. So we felt we really needed to close it, if not deploy it. And so we instituted it in an inactivity period. Immediately upon close, we freeze the fund, no fees, no capital calls, and then deploy when we see that type of capital is really necessary. And then in the meantime, we also recognize that Kiva Capital, through kiva.org, had built a tremendous network and infrastructure of being able to get capital to those places where the traditional channels were not flowing capital. And so we recognized we couldn't take our kind of focus away from this critically important refugee work, but we could help in domestic situations. We could help in getting very risk tolerant capital out. And so we added more resources. We were tremendously fortunate to hire more people, but then offer alternate funds that are focused on California, funds that are looking at subordinated capital across Africa, and then also working with USAID on a really innovative gender lens strategy. So we came into COVID kind of pretty narrow, but then we're able to kind of take on a lot more, and we feel, pretty humbled to be in that situation.
I appreciate that, Will. I think one of the themes we're going to get to pretty quickly today is this idea of being able to pivot, and what that actually looks like in practice, and the challenges and complications. And I think the narrative that you just shared is evidence of the fact that when you have an organization that has this deep, rich history, you have some options. You have some options to twist and turn. So thank you for that. Priya, why don't we move over to you?
Great. Thanks, Hannah. Thanks, everyone, for having me. So our private equity strategy, I really think, serves 4 different constituencies. The first are asset owners who truly they have the power, they have the wealth, whether they're an institution or a high net worth investor, and truly want to change the system that actually maybe help them get that wealth. And I think it's important to serve them. And I believe all GPs need to think of themselves as servants to the asset owners. Because I think it's difficult for folks who really want to have impact with their dollars to find good funds and people who kind of know how to do it professionally, both from a financial and impact perspective. The second stakeholder we serve are other GPs. So I've spent my career as an allocator backing emerging managers, impact funds, and women and people of color fund managers with no track records, as well as those with it. And part of our fund is we make strategic LP investments into impact funds that we believe can help change the financial system. I think we need to really transform it, and we need new players in this field. The third thing is we invest in companies, and we have a focus on companies who are driving better outcomes in health, education, economic empowerment, or sustainability through their core product or service offering. And our firm has a very explicit focus, not just in better outcomes, but greater access and narrowing the inequity gaps for who gets this type of impact in these areas. And so that brings us to the fourth stakeholder, which is the people in the communities who have been left out, who, we believe that for-profit companies and capitalism can serve them well, but we need that full alignment from the investor to the GP to the management team to build companies that actually truly do that. And we'll talk more about what we've done in COVID in the next few questions. Thank you.
Yeah, brilliant. Thank you, Priya. I am particularly interested in digging in on, I think most folks in the impact space know Impact Engine and know the brilliant track record. And I'm so curious about how you balance 4 different constituent groups and keep everybody happy, which is hard. And I know we'll get into it, but very appreciative that you bring that perspective. So thank you. Monique, how about you?
Yes, thanks for having me. So Cake Ventures is really the culmination of, my investing track record across venture capital, whether as an angel investor, a venture investor at 500 startups, or a VC scout at Lightspeed. And it's really taking a look back and saying, okay, a lot of investors are completely focused on the massive technological changes that are happening, but equal to and often more important are the changes to demographics and the changes to the internet user base that are happening. So for us, there are 3 big layers of demographic change that we're focused on. The first one is the massive aging population that we have in this country, a hugely underserved population that previously went under innovated, but now we're starting to see more companies come to market that are focused on the issues around aging in place, helping people save and manage retirement finances, or even doing things like, wills and trusts, or helping people stay in the workforce for as long as they choose to. The second big layer is companies that can get to billion-dollar outcomes based on the economic activity of women. So women as a user group are now able to drive companies to these large outcomes, and you're starting to see women with even more economic power, and where they put that money to work is really important to the second layer of the cake. So it's everything from, of course, consumer internet is a big one, but it's also in financial services and fintech, also in digital health and healthcare outcomes, as well as future of work. And then the final layer of the cake is the rise of this new majority, where people of color as a broad group become the majority in the United States. If you're building a global company, have always been the majority. And so, it's all about the way that these groups save, spend, and invest money differently across many different categories. When it comes to founders of companies, I invest in early stage companies, so seed through Series A. And when it comes to founders, I really look for founders who are often underrepresented. 55% of my deals have been into companies led by women. 60% of my deals have been into companies led by underrepresented founders of some sort. And while we don't have specific diversity metrics, I do believe that when you change who controls the capital and who controls the ability to write checks, then you change who ends up being able to create companies. And so those founders are another really important stakeholder for Cake Ventures.
Yeah, that makes a lot of sense. Monique, maybe let's stay with you, because I think you pointed to the constituencies that you serve, particularly around people of color, women, the aging population, and everything in between that cycle. That those are some of the groups that have been most directly affected by COVID. And I want to spend a little bit of time today talking to all three of you about that synergy, because a lot of what we're hearing in impact investing is people who aren't really drinking the Kool-Aid now looking at systemic failure across this pandemic and saying, oh my gosh, I guess we don't have a good strategy for serving female entrepreneurs or the aging population or caregivers. With COVID, maybe let's start with the positive. With COVID, is there any sort of silver lining in the pandemic hitting when it's hitting, as terrible as that is to say, that has actually helped you communicate this thesis? Is there any positive upside there?
So this was a thesis that I developed pre-COVID.
Right.
But as we sort of went into COVID, I was obviously fundraising, and then sort of had to realign and rethink my strategy once I was like, okay, well now we're raising this fund in a pandemic when everyone's sheltered in place. But what ended up happening came out of not specifically COVID, but came out of the George Floyd murder. And so I certainly saw an uptick in LP investors in particular really wanting to reach out and talk to Black fund managers and understand, there was certainly a lot of interest in that third layer of the cake, because the George Floyd murder then sparked these protests and sparked conversations around racial inequality. And so I think that, and I have mixed feelings about this, but it brought people to the table to have a discussion about this fund who previously were not at the table before. And so you saw companies like PayPal and Google, Alphabet, and SoftBank commit large pools of capital to Black entrepreneurs, and in a lot of cases also Black fund managers. And so the positive impact of that was that it brought people to the table to have the discussion.
Yeah, and forced the conversation, whether you wanted to have it in that moment in time or not.
Right, exactly.
Right. Yeah, makes a lot of sense. Priya, what about whether it's COVID or, as Monique rightly sort of pointed to, just a confluence of factors over the course of 2020? Priya, for you and for Impact Engine, is there a silver lining? Did COVID help illuminate the thesis, or simply bang the drum on a drum you've been banging, for lack of a better term?
Yeah, no, absolutely. when I set out to launch this strategy, I had a really big focus on, as I mentioned, like I think our ecosystem is missing truly mission-driven GPs in the middle market. But that fund to funds component is an uphill battle in a fundraising environment where folks are not just fee sensitive, but I would say emotionally driven towards direct investments and impact investing that far outpaces the emotional pull to directs outside of impact investing. It's just kind of this weird phenomena that is not good for the industry, by the way. And I knew that the benefits all along were there, and that diversification is something you want in a nascent market. And it's something you need if you're going to back first-time funds. And that's the problem. That's why people don't back first-time funds, because they're risky. But there's just a old toolkit thing called diversification. It's so simple. And I think in this I would chalk it up to like existential uncertainty, that everything has led to this, that investors don't know what is to come in financial markets, let alone society, in the next several years. And I think the silver lining was that the thing I had been kind of saying the whole time is like, diversification is your friend. This is also the time that we need new GPs. We need these types of investors. We need to back women and people of color. All of a sudden it was sitting right there, and I could just focus on that strength and that solution that was already there. And I think the other thing to what Monique kind of highlighted as well is, we've always been here to create impact. And I've always been here to create a multiplier effect and change the system, not just impact of the underlying companies, but I'm trying to create a ripple effect. And I think in this moment, when people feel the urgency to do something, and no matter what they do feels so damn small, and they feel like they can't possibly do enough, I think our systems approach and our multiplier effect all of a sudden resonates. And so I've seen that a number of investors who actually previously said no to the fund come back because they recognize the time, wow, this is exactly what I need, as well as other investors proactively reach out. So I think it's still a difficult fundraising environment, which we'll talk about that as well. But I do think there are some strengths here for impact investors.
Yeah, Priya, I love how you juxtaposed, but your whole argument is they should be working together, that this diversification thesis that never ever in life in any domain has it been good to put all your eggs in one basket, and this like very deep need to solve systemic uncertainty because, oh my gosh, in most of our lifetimes, we've never dealt with a pandemic of this size. As you're talking to investors, particularly about how both these things are important, are you finding you have to choose one, or are you able to make the case together for some of the other GPs that are also sort of first-time fund managers, or maybe just a new novel thesis? They're doing something cool and interesting, even if they're not first time. How have you guys seen success driving at both of those arguments?
You mean for when I'm fundraising, or when I'm, yeah. I think that's the dance that all impact investors who are raising capital have to make. You walk in a room and you're not sure if someone is walking in with an assumption that you don't know how to make money because you're trying to have impact, or you don't know how to make impact because you're trying to make money. And you have to kind of quickly figure out which one they're downing, because there really are so few that truly believe that you can do both. And so it's always kind of trying to figure that out, but it's the same story. It's more like, what do you have to beef up and like convince them that you can do this and have the proof points and all of that. But I think it's always that argument that like, actually, if you do both well, the outcomes, the financial outcomes and the social outcomes are stronger, but it's hard to get. It's the center of a very small Venn diagram.
Totally. No, that's absolutely right. Will, for Kiva, I think it's kind of magical and amazing that not to oversimplify your job, because I know you work hard, but the COVID opportunity has actually been an opportunity to ramp up, not ramp down. I was hoping you could talk a little bit about that, how that actually happened and what that actually means, in real life as Kiva's thinking about actually building multiple thematic options.
Yeah, I mean, I think it's tough to talk about a silver lining at a time where it's just a humanitarian catastrophe. I would say, Monique touched on it, right? You're getting new conversations with LPs and with new LPs, and if you're fundraising, right, that's gold, and especially so if you have a fantastic organization kind of behind you. And so, for me, any time I get a chance to kind of show off Kiva, to show off the investment people, to show off the impact people, you get these kind of aha moments in the eyes of investors. And it's to Priya's point, some investors are like, okay, you're probably really good at impact, but you don't have a clue about the making money side of it. And then we kind of show them the inner workings of how Kiva Capital is put together, and they kind of get excited. And then, certainly on the impact side of things, you've got impact focused LPs. They really want to get kind of into the nitty gritty and understand what we're doing. And then they kind of get blown away because they see the depth of impact management experience that's been built up over 15 years. So it's been great. I mean, I think it's been new partners, right? New LPs that I never would have thought 6 months ago that I'd be having conversations with different types of investors. And so that's forced me to kind of open up my eyes and say, I've been going after just one set for the last 10 years. And there's a need to kind of look outside the box on that and form kind of true partnerships. At the end of the day, though, the new money coming to the table is still a fraction of the need that's been created in the last 6 months. So it is tough to talk about a silver lining, but I think it's an imperative on everyone to find a way to just channel the new LPs for whatever reason they're coming to the table. Just channel their money, take their money, find a way to make an impact.
Yeah, I would imagine also that all of you have probably seen people that have previously said no probably come back to the fold. Maybe not a deluge. People are not banging down your door, but I think, Will, to your very thoughtful point about an opportunity to prove this double bottom line or this thesis, I think the pandemic has opened some people's eyes to realize that these investment theses are not for fun, they're harder. So the reason to do them is because there's some massive systemic inconsistencies. I think we would be remiss not to talk about all the ways that it's made things harder, and especially given who Kiva serves, I can imagine that that's something you guys live with every day. I mean, aside from the obvious, or we can talk about the obvious because it's important, what are some of the ways that the pandemic has actually made the whole process of raising a fund, an important fund with an important thesis, so much harder?
I mean, if you look at specific to kind of the microfinance investment vehicle market, right? I mean, that market's relatively well established. There's data, there's benchmarks going back to 2004, if not beyond. But a lot of that data and that kind of historical track record is based on a kind of a risk picture of the world that simply does not exist anymore. And so when we're kind of trying to estimate loss rates, when we're trying to paint a picture of what the risk could look like, given that the cone of outcomes from a macro perspective has never been wider, it's just very difficult to do. And so I think we always want to be as transparent, as conservative as possible with our LPs. But it is very frustrating when people say, all right, you've talked about this very stable asset class. I assume it will continue to be very stable. And I say, we're working in 80 different countries. Each country is a very unique case and is a very different stage of their journey fighting COVID. It's impossible to predict. And so the risk picture is muddier. And so I think that's made it harder. Just connecting with people has been harder. I'd love to hear, I mean, Priya's been an LP, right, and an allocator, but there's this idea, there's a lot of LPs that they feel this intangible quality they have, like, I can't make an investment decision unless I meet this person and shake their hand and look in their eyes without like pixelated Zoom views. And, so that's been tough, right? Because you can't get an allocation in COVID over Zoom. Some, fantastic investors have gotten past that, and I'm grateful for that. But there are people that won't make an allocation over Zoom, and that's tough to handle. I think that's the hard part.
Well, and to your point, we don't quite know when that's going to end. So this is not like to the point that you've made and the point that Priya and Monica both touched on about like consistent uncertainty. There's no goalpost here. We're not exactly sure when this all ends. So I can imagine that the resistance to the Zoom technique of fundraising is probably more stressful than even you're letting on. It's probably actually a big pain in the butt. Priya, maybe you can continue off of what Will was saying, and you've already touched on it, but share a little bit more about how the pandemic specifically, or to Monique's excellent flag, just socioeconomic forces across the U.S. have just made the work that you do, especially raising money, so much harder. If you could speak to that.
Yeah, sure. I think it's just important to recognize that there's a certain amount of like everything like stopped for a bit, and that was just very difficult, right? We were in the middle. We had already raised about half our fund, and we had people who were about to do the next close in like a few weeks, and everything just kind of like stopped, and that is just difficult. But I think the thing to remember kind of underneath that is that not only is there human loss, right, and death and all that, but as LPs and allocators and consultants and intermediaries, they're also having to take a pause that is very rational, because maybe half of their portfolio was decimated from public markets, no longer, but in that moment. Or they're dealing with estate planning issues because someone did pass away in the family office and they have to deal with that. Or there's a divorce, or you just have to walk back a family member from the edge of being like, screw it, like, I don't know how to, there's so much going on, and any investment they're making is almost certainly not the most important thing on their list. And so to deal with that lack of control over timeline, you never have it, but you definitely don't have it in a pandemic or when there's market uncertainty. And I think it's just really important as you're fundraising to have a lot of respect, and don't feel like you need to do something. Doing nothing sometimes is the smartest thing. I didn't really reach out to anybody for 2 months, aside from saying like, how are you? Is there anything I can help with? Like, I've managed a family office through a crisis before. Like, can I help you with anything? And not talk about my fund, not talk about that kind of stuff, was the smartest thing. And after that, it's relationship building, and it's genuine. Like, these are genuine people you want to get to know and help. Again, you should be there to serve them. And eventually in the last, 2-3 months, things have picked up quite dramatically. But I think if I had pushed it early on, you're just pushing up against a brick wall there.
I think I think the advice of do nothing is actually incredibly, not that you're saying it quite that simply, but that's incredibly thoughtful advice, because I think it is a reminder that, in the tricky power dynamic between LP, GP, and investee, there's still humans at all those points of contact. And sometimes that power dynamic doesn't let us really focus on the fact that humans are what we're basically talking about and talking to. And so that really resonates with me, because I think it's a reminder, actually, that at the end of the day, there has been some equal effect across the entire sort of range of folks that are involved. Monique, maybe we'll move over to you to same question, because I think that part of what I find so fascinating about Cake Ventures' thesis is that you, as you sort of said, you have been focusing on parts of society that have been very chronically ignored, and that urgency hasn't gone away. In fact, it's only amplified. If you could talk a little bit about how the pandemic or whatever has been going on sort of across the country has actually made things a lot harder as you're trying to sort of generate the right kind of attention for this thesis.
Definitely. So, last year, I spent most of my time with institutional investors. And once COVID hit and shelter in place sort of started, those channels were a lot more difficult to get to move, right? As Priya mentioned, everyone sort of paused. And even from a GP perspective, we sort of paused, right? We paused in reaching out to new entrepreneurs, having new entrepreneur meetings, and really just wanted to dig in onto our existing portfolio and figure out what was going to happen with those companies. And so LPs did a lot of the same. They wanted to dig into their existing fund managers and think about how they could be helpful and supportive to the existing funds that they had already made investments in. And that was a right decision for everyone to do. And now, so in response, my response was to completely change strategy when it came to fundraising and focus exclusively on individual investors and small, nimble family offices, because those were the ones who were going to be able to sort of wrap their arms around investing in a new fund and getting to know a new fund manager. And so I've almost exclusively talked to only individual investors, high net worths, and family offices. And as a result, I found an LP base that, works for me and works for Cake Ventures. A lot of my early LPs are, well-known GPs at other venture capital funds based in Silicon Valley or based in New York City. And those are the people who are driving this fund to a first close. And, I think it's all about being able to, yes, pause, but also react and change course very quickly when you realize that, the things that you thought were in play are no longer in play due to something that's completely out of your control, like COVID, right? And I think that, as I mentioned before, a lot of these large commitments from corporate venture capital or from large corporations were sort of the boon and the benefit of COVID and, the protests around racial injustice. And so being able to sort of strike while the iron is hot and lean into those sentiments are the way that, a fund like Cake Ventures gets funded.
The fact that your pivot was actually probably not what people expected, moving away from sort of these large institutions and towards, like you said, these smaller family offices or foundations that have a very explicit and specific focus, is not actually something that I feel like I've heard a lot about. I mean, it's a lot of what I've heard about is the opposite. So now there's sort of extra brand imperative to take a stand on some of these issues. And I love actually that you've focused a little bit more on the intentionality. Have you found that in expanding your own LP base and actually going to smaller, focused, intentional, is it that they get the thesis so much faster or quicker, or is it simply that there is less bureaucracy, or both?
Both.
Yeah.
Way less bureaucracy, and those individual investors in particular were faster to be able to sort of understand how to invest via Zoom, because a lot of them were having to do it in their own portfolios. So at that point, you just sort of become, okay, well, this is just another investment that that I have to figure out how to do without meeting in person. And I think that while there were a lot of conversations that were started by institutional investors and foundations, I think those were not as actionable as they needed to be in order to actually result in actual checks being written. And, I will also point out the fact that my view on impact is very, very different from a lot of other people's. My fund looks a lot more like a traditional venture capital fund than anything else. And so I think if you believe that impact comes in who you decide to back as a fund manager and who that fund manager then goes out and invests in, I think if you believe in that viewpoint on impact, then, Cake Ventures is for you. But, I think that a lot of foundations wanted me to come in and say, I'm raising a diversity fund. And I'm like, that's actually not what it is. It's thesis driven, and here's a thesis. And, you want people on the train who believe in the direction that the train is going, right? And so for me, it was all about finding the people who wanted to get on the train and believe in the direction that the train is going, because it's going that direction. It can't go the opposite direction of them. So let's all get on board.
Right.
And it was just easier for those LPs to say, oh, I really believe in, these demographic changes that you lay out. I understand that. It makes a lot of sense. We're seeing it also. And then, go just hop on and say, we believe in that.
Yeah, absolutely. This theme of pivots, I think, has emerged since the beginning, but I want to take some time to dig in even further. Monique, you've excellently started us off, because we're getting a lot of questions around, pandemic or not, major social consciousness around racial inequity in this country, whatever the it is. Fundraising is hard, and fundraising for anything that even labels itself impact is already hard before you even put in these pressures. And Priya, one of the things that I was hoping that you could talk a little bit about, and Will and Monique, please feel free to jump in, of course, is Impact Engine's journey. So you do such a brilliant job of talking about a history of pivots before we were even talking about COVID-19. And I was hoping that you could talk about what that journey has been, specifically given that you guys have moved to where the capital gaps are. Like, it's been a very responsive and thoughtful strategy. And maybe you could just take us through the Cliff's Notes version of how that's had to change for this sector.
Yeah, sure. Thank you too for those words. We were started as an accelerator in Chicago when a couple of professors at Booth and Kellogg noticed so many strong social entrepreneurs with business plans who wouldn't get funded because the local VCs didn't understand impact and the coastal impact firms didn't pay attention in the middle of the country. So we said, let's just do it. And so we had a 3-year accelerator, and we did well in a lot of ways, but what I'll focus on is that we were getting this incredible investor community in Chicago that had been overlooked, who really wanted to have an impact with their assets. And we realized it was actually kind of hard to scale that and meet that demand as an accelerator based on the size of the checks and the fact that not everyone wanted to be an angel investor. And so our first pivot came when we shifted and kind of stopped the accelerator and just launched an early stage venture fund. And we've now raised 2 of those venture funds, and as well as the private equity fund that I'm managing. And I'm kind of proud to say that I think we were responsive to what investors needed, and that we have a little over 100 LPs, and I think about 70% of them come from Chicago and the Midwest. And 2/3 of those investors have never made an impact investment before. So somehow we earned their trust, and we created products that help them make that first step. And we've really cultivated a really cool ecosystem here. We have events, 500-600 people come. We've educated a lot of people and helped them. And the second stat that I'll share that makes me even more proud is that 80% of those LPs went on to make more impact investments and credit us as being part of that journey. That's what we want. We're not here just for us to get rich and happy or even get any, thanks for impact. We're really actually here to grow the pie. And so we encourage and share other impact opportunities and funds with our LP base and want them to continue that journey. So when I came to Impact Engine, I joined as a partner a couple of years ago to launch this private equity strategy. And I was already an LP at Impact Engine and kind of friend of the community there. It was similarly, I had this gap I saw in the middle market. There were, well over 100 impact VC GPs, and I could only count 6 private equity GPs. That made no sense to me. And so I was setting out to start a fund that would fill that gap. And I came to Impact Engine because they were gap fillers and I wanted to fill a gap. And so it made sense to do it together. So we don't, our future will continue to be that. We want to be here to serve the ecosystem of investors, companies, advisors, and people, all in the same direction, and help everyone, row together in the same direction.
Yeah. I love that you said that. We actually just got a question in talking a little bit about, quite frankly, your experience, right? So you saw a personal gap. You are an investments professional. You were already setting out to solve that gap. You saw infrastructure, I'm sure, expertise and bandwidth in Impact Engine, and made that decision to sort of combine forces. Not at all to put you on the spot, but can you share a little bit more about, as an investor, what that process is? Because a lot of people on this call actually have investment theses that are innovative and new and opportunistic. They are not designing first-time funds. They've designed funds before, but what they want to invest in is quite different. And I would love if you could talk a little bit about that synergy, because I think that's a really, really interesting option to a lot of people that are joining us today.
Yeah, sure. No, that's kind of my focus, is people who are thinking about doing something different. And the question is structure. So I thought about starting my own firm. I thought I had a couple offers from banks who would seed it, but I'd be their head of ESG, which I did not want to be head of anything at any bank. And there was Impact Engine and actually a couple of other groups like that, which I could have linked arms with. And I think it's really different. It's hard to give like one piece of advice, but I think what really matters is think about your objective, your kind of core objective. What problem are you trying to solve? And then what's the quickest and most sustainable way, something that can be enduring, to get there. I have a personal bias, I'll be quite frank with you, about large asset managers creating bespoke impact funds, because I don't think there is full alignment. And I don't think if you are fully aligned around your objectives, I don't care how many resources, I don't care how many billions of dollars you have, I don't care. If there's not full alignment across and down on that objective, it ain't gonna happen. There are gonna be too many frictions. So I think if you are going to partner with another group, which can get you to where you want to be quicker than starting it on your own, it can only be done if that alignment is there. And I've seen many people do that successfully, and probably more people do that unsuccessfully, kind of rushing towards the dollar sign. Well, I wouldn't have to fundraise, or I wouldn't have to do this or that or that. Well, you're also going to have to give up a lot. That stuff comes with a pretty hefty price tag.
I think your point on alignment really, really resonates with me, because our client base are first-time impact investors that have taken the jump to make the commitment, have absolutely no idea what the next step is after that. And we spend a lot of our time I've made this joke before, but we spend a lot of our time as impact investing marriage counselors. You go into couples therapy and you say to your therapist, my spouse is the problem, fix him or her. And your therapist says, no, you're the problem. We're here to fix you. And it's a little bit of that, because it's if you are not really plugged into principally your limitations and then your capabilities, when push comes to shove, the thing that's going is the thing that least makes sense for the business. And to your point about how some of these things are carved out that are off balance sheet, tiny, small, someone's managing it that has 3 full-time jobs, that makes it really, really hard for that to have staying power. And this idea of alignment, which is not at all how we reference it and 100% being stolen as we speak, but this idea of alignment is really like the crux of it, that like if it's not part of what helps the business do what the business needs to do, we've got a problem. We've got things that you're trying to do at the same time with the same resources that aren't necessarily copacetic. And I think that we're getting a lot of comments in the chat saying like, yes, alignment, but I think that you're totally, I think, on top of where some of these large, quite frankly, asset managers and even asset owners really struggle. Is it going to be a small piece of what you do, or is it actually an instrumental part to the change that you want to see? And that doesn't always resonate with everybody, but I think we're seeing it in real time, and it's kind of tricky.
Yeah, and I think a way to think to clarify a little bit too is many of you, I think not everyone, but that one of your impact paradigm that people use is like product-based impact, and we talk about you want revenues to reinforce the impact, and that way it scales in a reinforcing way versus friction. Totally. It's the same damn thing with your partners.
Right.
Is the impact reinforcing their revenues, and is it completely tied, or is it not? And can it easily be cut or dismissed, or so it's the same framework you look at your deals with that you should look at your own business partnerships with.
100%. Thank you for that. Will, I want to spend a couple of moments taking advantage of your long track record as a fundraiser, and seeing as you're not being compensated for this webinar, it's like really taking advantage, because I think one of the things that I love very much about your career trajectory is that you've had to sit in a whole bunch of different fundraising roles for capital that's trying to be unbelievably catalytic. At Kiva, certainly no exception. A lot of folks on the chat are asking questions about trying to design COVID funds or designing funds that are responsive. Would love if you would impart some wisdom on us about some things that you've learned from your own fundraising journey that we can all sort of take with us, and or specifically as it relates to people putting together fit for purpose COVID vehicles, things to just stay away from. Oh, are you on mute, Will? Have we lost you?
I have a really fat finger, so when I press mute, like the computer just like weighs under, so it takes a hot minute. It's a good question. I mean, I think it gets back to kind of authenticity, right? You see people like, they've been in biotech their whole career, and now they're saying, oh, we're tweaking and we're going to have a financial inclusion fund. It's like, where's the authenticity? Like the passion is fantastic, right? The intent is there, but you want to look at like, what are you good at? If you're going to access what frankly is a limited pool of capital, you better be the best at, taking that capital to where it needs to go. And if you're not, like, you should make room for the Cake Ventures and the impact engines of the world who have proven, right, that they have that ability. And so I think it's authentic. There's this desire to kind of constantly pivot, but I think it is also, it's like, okay, what can we do? What can we harness, right? So what are the areas that we can focus on within our existing business or skill set that we can bring to bear versus like, let's do something new. There's a space for that, right? I think you're going to see in 10 years, this kind of COVID-19 cohort of companies that got started by people that were either laid off or felt a call to action that are going to be fantastic. But I think for kind of impact fund managers, I think it should be driven by, we can help if we build this fund versus we can grow if we build this fund, or we can bring on more people, or we can create more revenue streams, or we can take advantage of this market zeitgeist of interest and impact. I think it really has to go to kind of authenticity and building that trust with LPs, that you're not kind of a flavor of the month type person where every 6 months you're doing something new, right? I've got a bunch of people that are diehard impact investors. Last year, they were huge in crypto. 2 years ago, they were massive into cannabis. It's like, you're seeing this kind of, it's really hard to build that trust that way. So I think it goes to authenticity.
I actually love that you said that, and maybe wanted to steal even more of your expertise to talk a little bit about how first-time fund managers or people that really have demonstrated career-wise a commitment to the impact space but are in a GP role for the first time, how they can communicate that to LPs. I mean, is it just that if you're first time, it's going to be a hard nut to crack, or are there things that some of these first-time GPs can think about in demonstrating that they are authentically committed to this, just in a different way?
Well, I think speaking from our experience at Kiva, I mean, Kiva Capital is a year old, right? And so we were told we were a first-time fund manager. We brought investors in and we said, well, listen, Kiva has been investing in financial institutions for the last 15 years and has put out over $1.5 billion. We have the track record. So while we haven't had an explicit fund under management in the past, here's the breakdown of every single step in the process, and here's how we've done it. Right. And so it's really understanding what they're looking for and then showing, okay, you have a concern about this. Here's how I've done exactly that. And we'll do that here. Really outlining the process. So I think it's really kind of breaking it down to kind of that step-by-step level to show that you have that capacity and capability.
Yeah. Thank you.
I want to jump in really quick and kind of, dive deeper into the discussion around setting up multiple funds. One of the things I've seen lately is people setting up multiple funds for diversity and putting all of their diversity, like we have this main fund and now we have a diversity fund. And you see it on the LP side, you also see it a little bit on the fund manager side. And I think from an LP and capital allocator standpoint, if you are setting aside a fund that is just for diverse fund managers, you sort of acknowledge the fact that something is not working in your primary fund that you don't want to address, and that you now have to set up a completely separate sort of vehicle that brings in diverse fund managers. And I think if you're optimizing for, check size, because a lot of these funds are first-time funds and, raising smaller, have smaller targets, that's one thing. But if you are basically saying that we can't do this in our primary fund, that's another thing that you need to sort of address, right? And you must have some sort of path for the fund managers that you invest in out of your diversity pool, which is always a smaller pool, by the way, to then make it into the main, endowment or the main part of your capital. Because if you don't, then that fund manager just sort of like gets stuck in this diversity ghetto without actually getting access to larger and larger pools of capital as they scale. And I said the same, I made very similar comments yesterday in an article that came out in Bloomberg about people setting up separate diversity funds for Black and Latinx entrepreneurs. Like, we don't need a separate water fountain. That's not what people need. They need access to your primary pool of capital where you are returns focused and where you believe that if you invest in a founder that they are going to be able to return the fund. And so I think like when you start to have these conversations around setting up separate funds based on diversity, you have to really double click into why you are doing that and what is not working correctly in your primary fund.
I actually love that, Monique. I couldn't agree more. And I think the other thing that really worries me is when then those fit for purpose, mostly demographic efforts also have different return expectations. So you constantly find that we don't actually know that we're going to generate, exactly, we're not going to generate the same returns on this portfolio, or we're going to donate the proceeds or some other nonsense. And I would be remiss. Totally. I would be remiss not to take the opportunity to talk about, you've said something very specific as it relates to Cake Ventures. I've heard you say emerging demographics are the new emerging markets. And I think a lot of what is resonating with me in the way that Cake is designed is that it's not saying this is a special thing. It's saying this is an imperative thing. And I wonder if you can talk just briefly about not just why, I mean, obviously it's clear why you believe that, you have a track record of it working, but specifically why you think the intentionality of that thesis is so important.
Yeah, I think that in general, existing GPs and fund managers who are not investing in this way are missing out, and they're missing the signals that the world is actually changing. And so I intend to be on the forefront of investing in that change. And I think that if we continue to invest in the way that, venture capital funds have for so long, they're actually going to miss the internet user base shift. So it's actually a very to me, it's a very obvious and opportunistic even play, because I think that things are fundamentally changing, and large venture capital firms have big ships that can't turn fast. And this is a new ship. I don't believe in turning big old ships. I believe in creating new ships. And, this is the ship that's going to take advantage of this change to the internet user base that a lot of people just aren't seeing. And I think of that as truly opportunistic. And I think that a lot of my investments are going to be impactful investments, and will make impact in the world. And, those three categories that I talked about earlier are the ones that I think have the biggest opportunities for both impact and returns.
Absolutely. I love that. In this, I'm going to take your metaphor of putting a new boat in the water to wrap up with a 30-second question for each of you, especially because we have so many incredible new or would-be GPs on the call today. If you all could impart, given your incredible wisdom, the one piece of advice, I know that that's asking a lot, but the one piece of advice to new or old GPs about how they embark on this journey. What's the one thing that they have to do? And Monique, we'll start with you, since you gave us the analogy, you set us on this course.
Yeah, I would say that, when the playing field changes, as it did for all of us once COVID happened, don't be afraid to change the game you're playing. Because, I think if you try to behave as though it was 9 months ago and try to play that game, you're going to fail. And so, your ultimate goal is to get a fund raised and to get to a close. And if you have to change the game you're playing, then that just means that you're trying to be nimble and do it. And, the second little micro piece of advice is don't let people waste your time.
Yeah. That's a good one, whether you're trying to be a GP or not. I think that one goes on a Post-it note somewhere in this office. Yeah. Amazing. Thank you for that. Priya, what about for you? What's the one thing you think everyone needs to know?
Yeah, I would say, do what you said you were going to do, and do it with quality, do it with fidelity, and be transparent to your investors. You can't control the size and you can't control the timing. It's like where you start is definitely not where you finish. I've just one example, I backed one fund years ago. It was, a couple people managing $5-10 million for years, phenomenal track record. We wrote them a large check. Other investors realized this, because some people assume small means not good, and then you prove them wrong. He's $2-3 billion today. So where you start is not where you finish. But if you don't do what you said you would do with quality, you'll finish at zero.
Love that. Thank you for that. Will, what about you?
I mean, I'd love to just steal exactly what Priya said, but I think it's also being humble, right, and knowing what you can control, right? You can't control LPs, especially at this time where LPs are, have 1,000 different things that are demanding their attention. I mean, we are all human beings. Half of us are now school teachers, care of families. I mean, it's a very difficult time right now, and so there's a lot of things we can't control. But you need to have as many conversations as possible, right? And so I think there's an old problem that I've seen a lot of GPs. They just focus on here are 10 prospects. We're just going to keep hitting these prospects over and over and over. You can't control them. What you can control is the size of the funnel. And if you're having conversations with thousands of potential LPs, that's your best bet. Versus just hammering the same kind of folks over and over and over, because you just can't control that.
Yeah, I love that. I realize that we're at the top of the hour, and we could probably keep talking forever. I'm so just beyond grateful that the three of you made time to be here today, and that you have helped close chapter 1 of our webinar series with a ton, I think, of optimism and excitement on what this field can do, and a reminder, a clarion call to all of us, whether we're intermediaries, investors, or entrepreneurs, that there is something to be said for authenticity and focus and flexibility now more than ever. So Will, Priya, Monique, thank you so much for being here. Those of you who have joined us in this whole 4-part series, we so appreciate all of you for sticking around. As always, we will have a recording of this episode up on our site in about a week, and we hope to see you all again very soon. Thank you, guys.